G'day, my name is Dean Crocker. I'm an equity analyst with PSG Wealth, and today I'll be taking you through our latest EI report completed on AngloGold Ashanti. So on the 31st of March 2021, AngloGold released their full year 20 results. The results were significantly stronger. They were bolstered by 27% higher realized gold price, which offset marginally lower sales volumes. This allowed the group to expand their margins from roughly 28% to 40%. And on the back of that, they did report significantly stronger free cash flow generation, which allowed them to repay a significant portion of their debt and improve their gearing ratios. The group also successfully divested from South Africa. They are now purely outside of South Africa with their operations and nothing locally, following the sale of the operations to Harmony Gold. So in terms of our recommendation, we have updated from a neutral to an overweight. This is not to say that we are extremely bullish on the counter per se in isolation. However, we are, in light of the greater portfolio consideration, we would like exposure to the gold sector. Gold has historically acted as a very strong inflation and rand hedge, particularly during times of significant uncertainty. For that very reason, we have then looked at the gold counters, and out of the local peers, we do feel that Anglo is most likely the preferred counter to hold. Given that Anglo is also now completely divested from South Africa, they do tend to start to align with offshore peers, which implies that there could potentially be a re-rating towards those levels, particularly on an EV/EBITDA basis. That's not to say that is an event that will occur immediately, but there could be some upside in the near future. So in terms of the event, AngloGold really did report stronger commodity prices, and we've seen it across the board. They had a realized price of $1,768 per ounce. When the previous set of results, it was close to $1,300. So there was a definite improvement in terms of what they were actually able to realize in terms of prices. That being said, there was a slight reduction in volume sold, whilst increases in terms of all-in cost did remain well below inflation at 3%. That is quite an interesting component given that they are no longer exposed to South Africa, which would mean they're not per se attached to your local mining strike or wage season. In terms of the free cash flow, it did increase fivefold to $743 million, and the headline earnings did improve by more than 100%. The group declared a dividend of 48 US cents, and then obviously, as I mentioned earlier, they successfully disposed of the South African operations. So in terms of the impact on data release, the share price did increase by 0.19% relative to a market or the JSE All Share, which closed 1.3% lower. Since the beginning of the year, Anglo has, however, underperformed the JSE by 32%. And since September, which was our last EIA recommendation date in which we gave a neutral recommendation, the counter has fallen 48.7%. On the back of that, the total year-to-date return is negative 21.5%. So in terms of the valuation, the group is screaming relatively cheap relative to itself. Relative to its local peers, it does look quite expensive, however. But if you compare it to its offshore peers, there is quite a discount. So the counter is definitely screaming value across multiple vectors relative to its 5-year average. And on that basis, we do feel that the counter relative to its 5 years is probably neutral. But as I explained earlier, and I'll speak a bit about it a bit later, is due to our portfolio exposure and recommended portfolio exposure in terms of the gold sector, we do feel it's an overweight. So in terms of the assessment, the counter, as I mentioned, is trading at levels which we consider to be fair. It has reported a significant strong pipeline pending certain regulatory approvals, particularly in Colombia, which is an operation with significantly longer mine lifespan at a lower cost, all-in cost. Right now, they have managed to expand the life of their mines to 11 years, but that is really due to on facilitating existing mines. One consideration is that they are very skewed in terms of their ore reserves towards the new Abasi mine in Ghana. This mine is still in the process of being ramped up. So at present, they only contribute roughly 2% to EBITDA, but does contribute roughly 30% of the total ore reserves. In terms of the existing mines, their largest two mines, Valuation, and I cannot pronounce the second one, Delperium, The group these mines only hold roughly about 21% of the ore reserves, but contribute 45% to EBITDA. So that just adds context to the new Abasi mine. So as I mentioned earlier, we do, in terms of the portfolio, we would like to increase our exposure to the gold sector. It does offer inflation and rand hedge, particularly during these uncertain times. And on the back of that, AngloGold does offer a nice diversified earnings base. They have low gearing, a really sound balance sheet. They've paid off a lot of debt. I think that their debt levels are at the lowest they've been in the past 10 years. They have a nice strong pipeline, and they have existing operations which are performing very well and at margins well above what they've seen in previous periods. Yes, there might be some pullback in terms of the gold price. However, based on the all-in price, they still have quite a significant margin before it actually starts to cross to zero. So they are quite stable in that sense. And due to all of that, they are still a preferred counter relative to the likes of a Harmony or Goldfields on your local bourse. On the back of that, we propose an overweight recommendation for the portfolio. If you'd like to place a trade, please speak to either your financial advisor or the trading desk would be more than happy to assist. One final thing, just please take note of the disclaimer and have a great day. Thank you.